It's a quiet morning. A couple sits at their kitchen table, coffee cooling as they open a letter from their bank. Their mortgage is up for renewal. The payment is hundreds of dollars higher than it was 5 years ago. Across town, a small business owner reviews new loan terms for an expansion he had planned. The numbers no longer make sense. On a commuter train, an employee refreshes her investment app and watches her portfolio dip again after yesterday's market drop. None of them spoke to a central banker. None of them voted on monetary policy, and yet, overnight, their financial future shifted. Something distant and bureaucratic moved, and their lives moved with it. They didn't change their behavior. The number changed. Pose the central question. What if the most important number in your life isn't your salary, but the interest rate? Frame the video as revealing how this one number quietly controls borrowing, spending, hiring, investing, and recessions. Clearly tell viewers what they'll gain by the end. They'll understand why markets panic over tiny rate changes, and how to anticipate the ripple effects in their own life. Set expectation. Most people think rates just affect loans. Break it. Rates influence the price of money itself and modern economies. To see why this matters, run on borrowedmoney.transition line. We need to start with what an interest rate really is. What if the most important number in your life isn't your salary, but the interest rate? Most people think interest rates are just background noise, something that affects mortgages, maybe credit cards, and little else. A technical adjustment announced by central bankers in distant buildings. Easy to ignore, but that assumption hides something far more powerful. Interest rates don't just affect loans. They determine the price of money itself. And in a modern economy built on borrowing, where families finance homes, companies finance expansion, and governments finance everything, that price quietly shapes almost every major decision. It influences whether businesses hire or freeze, whether markets surge or fall, whether inflation cools or accelerates, even whether a recession begins. By the end of this video, you'll understand why markets panic over tiny rate changes and how to recognize the ripple effects before they reach your paycheck. To see why this matters, we need to start with what an interest rate really is. Now, imagine a growing regional restaurant chain. Sales are steady. Demand is strong. The owner plans to open 3 new locations and hire 40 employees. At low interest rates, the expansion is financed with a business loan at 4%. The projected profits comfortably exceed the borrowing cost. The decision feels obvious. Grow. Then rates rise. The same loan now costs 6%. On paper, that 2% increase seems small, but if the expansion was expected to generate an 8% return and financing now absorbs 6%, the margin nearly disappears. What once looked like healthy growth now looks fragile. The common belief is that companies hire when demand is high. That sounds logical, but hiring often depends just as much on financing conditions. Expansion requires capital, equipment, leases, inventory, payroll, all funded up front. Often with borrowed money. Startups and small businesses are especially exposed. They rely heavily on loans to survive early years of thin margins. When the cost of capital rises, caution replaces optimism. Hiring freezes, projects pause. Sometimes layoffs follow when money gets expensive. Jobs become expensive too. But businesses aren't the only ones reacting. Investors are watching the same number. An investor watches the news. The central bank raises rates by 0.5%. The next day, the stock market falls sharply. He scrolls through earnings reports. Profits haven't collapsed. Sales are steady. Nothing dramatic has happened inside the companies he owns, so why the panic? The common belief is that stocks move based on current performance. If a company is profitable, its stock should be stable. That sounds reasonable. But stocks are not priced on today alone. They represent expectations of future profits, sometimes decades ahead. And those future profits must be compared to something. If you can earn 5% safely in a government bond, any risky investment must promise more than that to feel worthwhile. When interest rates rise, the safe alternative becomes more attractive. Suddenly, future corporate earnings have to compete with a higher baseline. The higher the rate, the less valuable distant profits appear today. Growth companies whose earnings are expected far in the future feel this most sharply. Stable dividend payers generating cash now tend to move less. Interest rates decide how much the future is worth today, and when the future becomes less valuable, something else begins to break. At the grocery store, prices feel higher every month. Eggs, milk, vegetables, each receipt confirms the same suspicion. Something is wrong. The easy explanation is corporate greed or temporary supply disruption. Companies, we assume, are simply charging more because they can. That's That sounds reasonable, but it misses a deeper force. When interest rates stay low for long periods, borrowing becomes easy. Consumers spend more freely. Businesses expand aggressively. Investors chase higher returns. Asset prices rise. Speculation increases. Demand across the economy accelerates, often faster than supply can respond. More money chases the same goods. Inflation, in this sense, is not just about companies raising prices. It is about a system flooded with inexpensive credit, amplifying spending everywhere at once. So central banks reverse course. They raise interest rates to make borrowing harder and slow demand. The intention is simple: cool the economy enough to stabilize prices. But the slowdown does not feel gentle. Growth weakens, hiring slows, markets stumble. The same lever that stimulates growth is the one that slows it down. And if that lever is pulled too hard, the entire system can tip. Picture a period of stubborn inflation. Prices are climbing too fast and public pressure builds. In response, a central bank raises interest rates aggressively. Meeting after meeting, the cost of borrowing moves higher. Officials describe it as necessary, even responsible. The goal is clear: restore stability. At first, the effects seem manageable. Spending cools slightly, housing slows, markets wobble, but higher rates ripple out. Businesses delay investment. Consumers pull back. Loan defaults begin to edge upward. Hiring freezes quietly replace expansion plans. The assumption is that raising rates simply stabilizes prices, and sometimes it does. But tightening financial conditions too quickly can suffocate growth altogether. History shows a pattern. Nearly every modern recession was preceded by a cycle of rising rates, not because policymakers intend to cause downturns, but because slowing an overheated economy without stalling it entirely is extraordinarily difficult. Recessions don't appear from nowhere. They often follow the cost of money rising. So if this one number influences housing, jobs, markets, and inflation, what does that mean for you? For most people, interest rates feel abstract, announced in press conferences, debated on financial news, then forgotten. But now, the pattern is clearer. When rates fall, borrowing becomes easier, risk-taking increases, and growth accelerates. When rates rise, credit tightens, investments reprice, and job markets cool. This is not about predicting the next decision. It is about recognizing signals. If rates are low, locking in long-term fixed debt can protect you from future increases. If rates are rising, building a cash buffer and reducing variable debt becomes more important. When money grows expensive, risky assets tend to struggle, and job security can quietly weaken. Understanding this lever changes how you interpret headlines. A rate hike is no longer just news, it is a shift in economic direction. If you understand interest rates, you can read the economy before it reaches your paycheck, but there's one deeper layer most people still miss. If interest rates are this powerful, the obvious question is, who decides where they go? Central banks set benchmark rates, but their choices are rarely simple. They faced political pressure, rising government debt, fragile job markets, and global shocks they cannot fully control. Raise rates too slowly and inflation can spiral. Raise them too aggressively, and recession follows. Lower them for too long, and asset bubbles quietly inflate beneath the surface. In other words, even the people adjusting the lever are reacting to forces larger than themselves. That raises a deeper uncertainty. Are rate decisions carefully predictive or mostly responsive? Are policymakers steering the economy or scrambling to stabilize it? I'm curious how rate changes have affected you. Has your mortgage, your job security, or your investments shifted because of this cycle? In the next video, we'll examine how central banks actually set rates and whether they truly control the system. Because if interest rates control your life, the next question is, who controls them?